Steve, thanks for joining us today to talk about the closed-end fund market in the month of June.
Sure.
When we last met at the end of May, the theme was sort of weakness in the market, but things were slow as we began the summer. So fast forwarding 30 days from now, what sort of happened in the market from a discount standpoint and from a total return standpoint?
In the past month, the capital markets were fairly volatile. The U.S. equity market was down about 2%. Same with high-yield bonds, and the Barclays aggregate was down about 1%. In the closed-end fund world, it was much more volatile. The average closed-end fund was down 4%. That was mostly discount winding. The net asset values were down about 2%, and so the total return was negative 4%. The discounts ended the month at about 9%, which compared to the end of May, which was 7.3%, we saw almost 200 basis points of discount widening. And I think that's pretty remarkable given that discounts at 9%, the last time we saw that was April 2009. And as if you recall, back in that time, high-yield bond spreads were 15% over. The U.S. equity market had just undergone a 60% market correction versus now, high-yield bond spreads are at about 500 basis points over. The market's near an all-time high. And so it's just a different market environment. It's quite the opposite, but discounts are the same. And so I think it's fair to say that the closed-end fund investor is much more fearful than your average cash bond or cash equity investor.
That's interesting, Steve. So if I hear you correctly, discounts were markedly wider from May to June, putting us in a range that we haven't seen for quite some time. Yet the environment that we're in actually seems much better than the last time that we were at a similar level of discounts. So should investors now feel some level of safety around the fact that discounts are as wide as they were in a much different world?
Sure. I mean, I wish market prices, the net asset values, were the same as they were back in 2009. You know, the equity market tripled off the low, and high-yield bonds have put up double-digit annualized returns ever since. And so you don't have the same asset class opportunity because, you know, asset classes are fair to richly valued in many people's opinions, but you do have a great relative value. And so for any investor that's already invested in equities or fixed income, it makes a lot of sense to look at the closed-end fund market today. You're looking at discounts that, you know, the average is 9%, but we're seeing a lot of opportunity on very large, liquid, well-run fixed income funds and equity funds at 14, 15% discounts. And so at that level, you know, maybe they go wider. We might have some tax loss selling later this year, and there's also potential for more interest rate volatility and capital markets volatility during the summer. But buying in at a 14, 15% discount, you know, there is a lot of nice asymmetry to that trade. Again, I mean, I can't tell you that there's going to be absolute returns from here in terms of just great positive absolute returns at this discount level. But when you have this relative value, it makes a lot of sense to replace other types of market exposure with closed-end funds.
Steve, thanks for your comments today.
My pleasure.